just going to say I want to keep things rolling since I know we're a little off schedule as it is already. So are there any current Young Alumni Council members sitting in on this session? If so, could you please raise your hands? So since I know 2 of you are in here right now. So when you're talking with them, feel free to ask them about this event, learn more about different events, and thank them. So my name is Megan Copes Fisher. I am also on the Young Alumni Council. Let me introduce to you Jeffrey Courtwright, who graduated in '96. Jeffrey spent 6 years building a foundation of knowledge in the financial industry before starting his own independent registered advisor firm. His philosophy centers not on money, but attitudes towards money. By educating clients on their personal bias towards money, the advice resonates and sticks. Jeff is a certified financial educator and works to raise financial literacy whenever he can. Please help me in welcoming Jeffrey.
All right, when I practiced this, it was a 20-minute presentation. Last time I got cut off. So we're going to cover a lot of information. The 2 sheets that you've got, I'll talk briefly about and mention throughout the presentation, but those are for you to take back. Also, we do have a table outside, so if you see Amanda, my assistant out there are some folders out there with additional reference material that you might want as well. I'll talk a little bit about it as we go through. I do need to disclose that I do own an investment advisor firm, and that means that I'm not licensed to practice law or to do tax advice, but I am licensed to provide investment advice, and because of that I have to do disclosures, legal mumbo jumbo. This is today's agenda. I could talk for each of those bullets for a half an hour, so I'm going to kind of speed through things. If you have questions, save them till the end. I encourage you to write them down on any of the pieces of paper you have. I'm more than happy to answer those questions at any time. In fact, I do provide education without any cost or obligation. So if you're doing the work and you say, how does this look? I'm more than happy to say, have you thought of this or that or this? Or maybe if you do this a little different, that's all free of charge advice that helps you. It's when you say, I don't know what to do with all this stuff, can you help? That's when I'm going to charge a fee to do that, okay? Survey. How many of you currently budget? Good, good. How many of you equate a budget to something bad? Wow. Okay. How many of you can equate a budget and envelope, the word envelope? How many of you heard those two and good? How many of you have debt? Okay. How many of you have ever heard of the debt snowball? Couple. How many of you are earning more than what your minimum payments are on debt right now? Couple. Oh, almost everybody. Good. How many of you who are married or have a significant other talking marriage or plan to keep your finances separate? Nobody? I'll tell you, it can be a marriage saver. How many of you understand your credit report? Couple, good. How many of you have ever been a victim of a scam or identity or account theft? Oh, there's gotta be. I myself have had to get new Discover cards like 4 times in the last 2 years. It happens to almost everybody. How many of you currently have a financial advisor? Okay. How many of you have an insurance agent? Okay, those of you who didn't raise your hands, stay away from me on the roads at home. Because if you've got car insurance, you've got an agent. How about a lawyer? How many of you have a lawyer? What about an accountant? Okay. I want an accountant that's not you. How's that? I want you to understand that your life today, you have different zones of planning and emphasis in your life. I call those zones of emphasis foundations. You've got your legal foundation, your tax foundation, your risk foundation, and your financial foundation. Those 4 foundations can play very well together, or they can fight against each other dramatically. And I'm going to share stories about all of those as we go through. I want everybody to change your mindset. Your house is no longer personal. Your house is a business. Every successful business has a board of directors and a CEO. You're now the CEO, or maybe the co-CEO, of your home business. You need a board of directors. You need some professionals to provide advice to make sure that you can be a success. You need that lawyer. You need an accountant. You need a property casualty insurance agent. That's where you get that house insurance or renter's insurance and car insurance, all that kind of stuff. You should have a life accident and health insurance agent. Even if you have group health insurance and group life insurance, you should still have an insurance agent to help you decide which plans that you choose. You should have a banking relationship, someplace where you can write checks, where you can do banking and liquid transactions. You should have a financial planner whose only job is to provide advice and help you plan for the financial pieces. And you should have somebody that's dealing with your investments. Now, there's ample opportunity for people to hold more than one seat at this table. But I want you to evaluate and make sure that there's at least 3 people around the table with you, not including you. If you've got less than 2 people sitting at your board of directors table, there's a good chance there that somebody could take advantage. Somebody could try and exploit the situation and take advantage of you. So have at least 3 advisors. Don't let them work in a silo. Make them sit down at least once a year. And if you've got professionals already and they're not willing to sit down at the table as a board of directors and talk about all the different planning that's going on, you should probably consider interviewing for a replacement. We'll talk about why as we go. Your legal foundation has a couple of different issues. In 2011, Phase 2 lost 25 clients, client family members, and staff family members due to death. It's more than I experienced in the previous 9 years in the business combined. Really drove home that the legal foundation is probably the most important piece I'll talk about because of its impact on your financial life. We had a 19-year-old that died this last year. There are issues that she's dealing with and her family is dealing with that they never had to deal with as parents. What happens to her Facebook and Twitter account? There's no real clear procedures for how those are dealt with when somebody passes away. Companies haven't had to begin to deal with that yet. They didn't talk about what she wanted done with her stuff. They actually ended up burying her with a lot of family heirlooms that have been passed down multiple generations. Is that what she wanted, or is that what the family wanted? Her parents were divorced. They kind of fought over, was she going to be buried with dad's family or mom's family? So no matter how old you are, these are things that you should think about. Start to make some notes. Now, I'm not saying go overboard like my wife, who's got on the computer at home a little link, Penny's Funeral, that has her playlist already in iTunes and her slideshow with all of her pictures that she keeps updating and adding to. I'm not saying to go that far, but understand that you should be making some notes. A good attorney will also make sure that things avoid probate, that your stuff is taken care of, and start to tell people what you want as your service wishes. My mom surprised me when she said, you know, you're taking care of my money, so you need to make sure there's enough there to rent a convertible. Even if I die in January, you need to rent a convertible, and you and your sister need to take my ashes, head north, cross the bridge, hang a left on US 2, get outside of St. Ignace, pop the top, let me go. Kind of surprised me, but that's what she wants. Now, I'll pretend I didn't say that and hope the camera didn't record it, since it's illegal to spread ashes like that. But tell people those things. I would have never guessed, and I would have tried to get a vault right next to my grandparents for my mom to be there. And that's not what she wants. Your tax foundation has 2 distinct parts, your working years and your retirement years. We all in this room have significant issues with the retirement years. The reason is, when we look at the number of workers that are contributing to Social Security and Medicare and Medicaid, it's lower than it's ever been. The usage is higher than it's ever been. Would it shock you historically to know that in 1956, the top tax bracket was 92%? 92% of your earnings would go to the federal government in taxes. In the mid-'80s, the top tax bracket was over 50%. So we are at historically low tax brackets today. And even in the state of Michigan, this last year, they started taxing distributions from IRAs. That's another 4% in taxes you'll have to pay to the state after you retire when you take money out of your IRA. Something that current retirees weren't banking on, weren't planning for. Your risk foundation, there are 3 choices that you have to make when you talk about offloading risk in your life. You can be fully insured, meaning you get in a car accident, you get that brand new car, or 1 year or more recent, or whatever the newest commercial is that's on TV for replacement value. You pay a higher premium to get that brand new car for the value that you purchased, but you're fully insured. You could choose to self-insure. In other words, you save a lot of money for the expense. Imagine sometime this summer you're out in the backyard, you're grilling, you're enjoying friends, family, you're cutting the tomatoes to go on those beautiful burgers, and the knife slips and gets your thumb really good. Well, everybody's been enjoying the sun and the cocktails, so you know you need to call an ambulance. They do some x-rays, they do get the blood stopped, they send you to tell you to cut some tendons, now you need a surgery. Well, if you choose the self-insurance option, and this actually did happen to a client this last year, so I can give you some hard figures here. $250 ambulance ride, $2,500 emergency room, and that was without the doctor's charges. Consulted on the surgery, $14,000 for the surgery, and that didn't include any therapy or recovery afterwards. That was the surgery itself. So you're darn near $20,000 of self-insurance if you don't have health insurance in a situation like that. Partial insurance is your typical health insurance. You might have a $50 copay for the ambulance ride, you might have a $2,500 deductible, and then 20% copay until another $3,000. So now your $20,000 problem with your thumb is more like $5,500. Most people choose some form of partial insurance. They're going to save some money and pay less of a premium and have something out of pocket. When you deal with people in the risk foundation, the insurance salespeople trying to sell you insurance, I want you to understand, if the person across the table only talks about the premium that you're going to pay, the cost of the insurance, you need to stop the meeting, end the meeting, and find somebody else to talk to. Your financial life is more important than a premium every month. The lowest premium might mean that you could have a $7,500 instead of $5,500. And the savings might only be $25 a month. So for $25 a month more, you have significantly less out of pocket. When we talk about the financial foundation, we're going to break it into two pieces. The first is cash flow, and this is where we get to budgeting. I want you to understand that budgeting should be a freeing event for you. My wife, when we first started dating over 15 years ago, she had a spiral-bound notebook, one of those 5 subjects. You're probably all familiar with them from classes and notes. I used to laugh at her, almost roll on the floor laughing at her, because every payday she'd sit down with her calculator in this spiral-bound notebook and she'd flip to the different subject areas. It'd take her like an hour to assign her paycheck to like 100 different sub-accounts in here. She had her hockey fund and her baseball fund and her concert fund. She had her work clothes and her fun money and her whatever else. And I just laughed and laughed. And then one day she said, well, do you want to go to the concert over at DTE? My budget said I didn't really have any entertainment money, so, well, not really. Well, I'll buy the ticket. I've got $500 in my concert fund. That's freedom. Now I know, because she's the only one that can handle that kind of detail at home. Now I know if I spill something on my tie or I rip my suit or something like that, I know I have a Jeff work clothes account. I can ask her, she'll pull up the spreadsheet, boom, here's how much you've got if you need to replace the suit or the tie or whatever. I know I have an account just for work clothes. That's freedom. So don't think of it as a bad thing. Think of it as a real good thing. But this helps you prepare for job changes as well. I have a client that lost her job over 2.5 years ago. She bought a house 6 months before that. There's a lot of people that lost their houses because they lost their jobs. She's still in her house. She had a cash reserve set aside. She's done odd jobs while she's been looking for permanent employment. And after 2 years, she decided, you know what, I'm just going to start my own business. She couldn't find anything in her field, so now she's starting her own business. The only way she could do that is through the discipline that she had through the budgeting process and building her own financial foundation. You've got lots of tools and resources. You could be old school paper and pencil like my wife was with that spiral-bound notebook. I finally got her to go to Excel for a spreadsheet, but there's like 100 different tabs at the bottom. It's so funny when you pull it up, you can't even read what's on the tabs because there's so many of them. But you know, I finally got her to go there with a computer-based spreadsheet. Some of the new school stuff goes right on the smartphone or the tablets. There's 4 of them that I'm working with right now that I'm kind of evaluating for clients. There's one called EEBA. It's an envelope system. So I want to mention the envelope system briefly. The old school envelope system used to be you buy a box of envelopes, and on the first one you write work clothes, on the second one you write rent, on the third one you write groceries. When you get your paycheck, you cash it, you put money in each of those envelopes. So when you go grocery shopping, you take your grocery envelope, and that helps you decide whether you're buying the T-bone or the ground chuck. Okay? So they have an EEBA app right on your smartphone or your tablet that you can use that envelope system. Another one is mint.com. I'm kind of liking that one. You can actually link it to your bank accounts and your credit card accounts and everything, so you can designate expenses off of your credit card statements so you can see your spending patterns. There's another one called Pocket Budget and another one called MoneyWise. One of those, and I don't remember which right now, isn't real nice on the free version. They really want you to buy the other version. So evaluate those. Play with them a little bit and see what it is. But the mint.com one right now is really getting some good marks from me. If you're an envelope old school person, definitely consider that EEBA app. Look for website consolidation and coordination. Don't use 4 different things. Every bank has their own website to try and help you manage your money, but if it doesn't pull in everything else, it's not really that beneficial for you, in my opinion. When we talk about assets, I want to address first the collectors in the room. I could have been a millionaire back in the 80s. Now I just have 3 shelving units full of baseball cards. It used to be worth some money a long time ago. It's not a collector. That's an accumulator. Think about it that way. If you're buying and selling things, you're a collector. You're buying and you're selling. You're trying to gain value. If all you're doing is putting things on the shelf, you're really an accumulator. I had a client who lost a family member this last year, and in the will they were left the collection of precious moments. They're such cute figurines, aren't they? Well, after looking at the 50 figurines that she inherited as part of this will, she thought, well, they've got to be worth something. So she went online, and the most valuable one was worth 50 bucks. And when she added up all the 50 figurine values, and she found some receipts and the little price tags that were on the boxes, they were actually worth less than what her family member bought them for. So she ended up keeping 2 that had sentimental value because they were purchased around one of her life events by this family member. The rest of them she put in the estate sale instead of going to an eBay store, and she ended up with 750 bucks off of like 48 precious moments. So try not to be an accumulator. My wife and I were engaged and married at lighthouses. Imagine what we have around our house. Family loves to buy things when they know there's a theme like that. We've since put the family on notice that we are turning from an accumulator of lighthouses to a collector of lighthouses. We have certain lighthouses that have meaning to us. We have certain styles that we'd like in certain rooms. We don't want to have a hoarding room of lighthouses. So think of yourself, anytime you have an accumulation, like Star Wars figurines or strawberry shortcake or whatever it was from your childhood that you might still have, remember, if I had more of this, would I be on an episode of Hoarders? You're probably an accumulator and not a collector, okay? I want you to understand a little bit more about the bias and conflict of interest in the industry. I want you to understand that there is a war going on in the financial industry between the sales-driven model and the advice-driven model. The sales-driven model is product-driven. When you talk to an insurance person, I'll bet you insurance is the best way to get to whatever you want in life. Talk to a stockbroker, I'll bet you stocks are the best way to go to get to where you want to be in life. That's a sales-driven model. It's product-specific. They have what's called a suitability standard. In other words, according to your risk profile, your time horizon, this is a suitable product for you. It's your job as the consumer to go out and research and know whether that's the best thing for you or not. And that sales model is commission-based. They get a commission for selling that product. The advice model is more situation-driven. They need to know everything about you before they can tell you what you should do. There's what's called a fiduciary standard. That's a legal obligation to help you do what's right for you, whether they can make any money or not. Most of the time, that's fee-driven. In other words, if you want me to tell you what you should do with these precious moments, pay me and I'll help you figure it out. Or just put them in the estate sale, okay? So that's the advice-driven model. There are hybrids out there that can operate on both sides of that fence. what I want to tell you about the disclosures or the lack thereof. Wall Street Journal recently did a study of American consumers, and after showing 1,000 American consumers the disclosures on a brokerage statement, 67% of those people said they were less likely to go talk to a broker about their accounts. Because right in the disclosure it says this is a brokerage account. We earn revenue from the products and services inside this account that may put our best interest at odds with yours. Most people think that their stockbroker is an advisor. Their title is a financial advisor, but really they're on the sales side of the spectrum. So make sure you read the fine print and see the disclosures or lack of them. So in other words, the hybrid person, they have to choose which hat they're going to put on every day. Am I going to be a salesman today or am I going to be an advisor today? And sometimes that can be confusing, and sometimes they have both hats on and they're not really talking about that. Talk a little bit about how those foundations can either work against each other or with each other. The titling of your accounts trumps your estate plan. So you can have a great attorney that drafts wonderful trust or wonderful will for you, so everything is going to avoid probate. You want your mom to get all of your money. You want your mom to get all of your stuff at the house. But your dad was at the loan office. Your dad signed on the deed with you. He's a joint owner. If you die, your mom doesn't get the house, your dad does. I had a client that happened to. They lost their mother, and in the will, mom said, I want the house sold and split between my 2 kids. When I went to help with the estate sale, the daughter, my client, she was carrying a box out of the house and asked her brother, when's the realtor coming? You know, mom's will said we were selling the house and splitting it between us. Her brother looked right at her and said, you don't have to worry about it. The house isn't part of the estate. It's in my name. That's all I have to say to you. So even the best laid financial plan, if your titling isn't in concert with that, it will conflict. Beneficiaries. Here's a great story. My dad called me just a couple years ago. He said, hey Jeff, we just got a check in the mail. Can we cash it? I can see the check through the phone, right? I don't know, Dad. What check are you talking about? Well, you know, my wife's ex died a couple months ago, and we just got a check from the insurance company, and they had a letter that said she was a beneficiary. Can we cash it? She's a beneficiary? Yeah. Okay, that's all I needed. Wait. What do you mean? Does he have a wife now? Well, yeah, he got remarried and had a couple kids. Okay, do you think that his intent was to have his current wife be the beneficiary? Well, probably, but he didn't change it, so hold on a second here. Let's talk about this. After a guilt trip, I think that they did end up sending a little check to him, to his family, his other family. But you get divorced, if you don't change your beneficiaries, the money goes to that beneficiary. It doesn't go to who you want. So this is another reason why that board of directors needs to get together once a year. And if you have a professional that's not willing to sit at that table, interview for a new person. I want to talk a little bit about lifestyle. I live on a street in the suburbs in Jenison. The only 2 types of people on the block, young families and retirees. You can tell who's the retirees when you drive down the street. Lawn's perfectly manicured, edged on the side, on the driveways, no weeds. You can tell the young families. Maybe on Sunday, you can tell it was mowed on Saturday. Maybe, if they were around, toys all over in the front yard. When you're trying to keep up with the neighbors, remember that just because they have a boat parked in their driveway doesn't mean that they have the same life goals or the same resources that you do. So don't try and keep up with the neighbors just because their lawn's immaculate and they don't have any weeds. There's a reason they might not. They don't have to do anything but care for their lawn. Okay? And don't ignore the future. If you look at this saving tips and future values, you'll notice right at the very top, I can do this with the best of them, so I'm not saying that I'm perfect here. I'm saying this is a problem for me too sometimes. That $3.50 latte on the way to work every day, if you made that one decision to not get that latte and saved that $3.50 a day over the next 20 years, you'd have $43,580. And that's not a stock market return, folks. That's inflation. So again, understand that when you ignore the future, every decision you make can cause a problem for the future. There's a couple other tips and tricks on that sheet as well. What I want you to understand about the financial interaction as well has to do with your saving and investing. The first thing that you should do is build an emergency fund. That emergency fund should be, at a minimum, your health insurance deductible. Because when something happens, you don't want to have to screw around with the hospitals. You want to make sure that's taken care of. The eventual goal that I have for most of my clients with an emergency fund is 3 months of expenses. That's an emergency fund. Christmas is not an emergency. T-ball is not an emergency. Okay? The emergency fund is undedicated dollars that is there for a tire blowout, or whatever the case might be. A cash reserve is very different. Cash reserve is what allowed my client to go for 2.5 years without a job and still keep her house. Cash reserve, the ultimate goal there would be to have 12 months of income as a cash reserve. Notice, your emergency fund is 3 months of expenses. Your cash reserve is 12 months of income. Significantly different calculations. Don't be an insurance poor person, especially right out of college or shortly out of college. I met with a couple just a couple months ago. They said, Jeff, we're having trouble making ends meet. We can't figure out why. I said, well, let's talk about what you're doing. We had them go through a monthly expense worksheet that's in the folders out on the table out there. Come to find out they had 4 different life insurance policies, 2 different disability pieces, some cancer insurance, some accidental death insurance. They were insurance poor. If they died, they were rich. Their kids were rich. But until then, they're eating beans and rice, ramen noodles, whatever it takes, just to have insurance. It takes a balance. So I want you to understand that anybody who says you need more insurance, you got to balance. Being partially insured is better than being fully insured and not having a life. It's a lot harder to stick to a budget when you have no life to live. And don't leave any money on the table. As you're interviewing or as you're working for a company, if they have a match in their retirement plan, that's free money. If a client, their company matches 100% of their contributions up to 5% of their income. So he puts 5% in his retirement plan. Market goes down 50% in a year, he doesn't care. Because he had 10% of his income going in, not 5. He hasn't lost any money. And then when it recovers, boy, got a lot of shares dirt cheap. So don't leave any money on the table like that. And I'll also mention, if you are an independent contractor, here we go. If you're an independent contractor or you're working as a self-employed individual, there are significant opportunities for you to make a contribution as yourself and as your own employer, your self-employer, to save a lot more money towards your retirement while you're younger. And again, on that saving tips and future values, you'll see the paying yourself first. If you can do $100 a month, that's $1,200 for a year. That's basically your daily cup of coffee. And you can get 10% a year on that. For 10 years, you've got $20,000 there. Significant growth. Again, your life today is 4 foundations. You need to have a professional who can help you with each of those specific areas. Those professionals should be a part of your board of directors. Make sure that they're talking about your situation together. Don't let them talk in silos. Because when you have silos and people don't know what's going on between each other, that's when you have a house that goes to somebody you didn't want. Conclusions. Let the word budget become the word freedom for you. Again, don't think of it as handcuffs. Think of it as, let's build something on my tie. I'll just go get some money out of the work clothes account and boom, new tie. I thought it was old style anyways. Understand the motivations of the advisors in your life. Don't just take their word. Question them about why they're telling you to do this or that. Make sure it's teamwork. Create assets. Let your money work for you. When you're spending and creating liabilities, and those baseball cards in my basement are still a liability, especially with my wife now. When you create liabilities, that means that it's harder to live your life. And also be deliberate when you merge your finances. And what I mean by that is as you get married or as you get divorced and remarried, whatever happens in your life, make sure that you have discussions. Because remember, the titling and the beneficiaries can have a major impact on things. And a lot of times, I talked about how many people had separate finances. Separate finances can save marriages. I have an account that my wife's name's not on. She has an account that my name's not on. We have an account where we pay the bills together. It's wonderful. I can go buy her something. She doesn't have to see how much I spent. That's even better. She can do the same. So sometimes having some separation in a relationship can help save the relationship. Any questions, I guess, since we're...
All right, Jeff, I'm going to get realistic on you here.
Wonderful.
My first job out of college, I was a starving journalist. I made 19 grand a year. I had barely any insurance. I couldn't afford it. So the top 3 things that, for those of us who cannot afford a board of directors,
you can always afford a board of directors. Because a good attorney, a good accountant or tax preparer, a good financial professional, those 3 individuals are going to recognize value in your potential, and they will work with you.
Okay, so you're saying a person who makes minimum wage can afford a board of directors?
Yes.
Okay.
I'm saying a person making minimum wage can't afford not to have a board of directors.
Okay, so what are the top 3 things that you would say we need?
Emergency fund first.
Okay.
You need to make sure you're getting yourself out of debt second. And you need insurance. You need health insurance. That's your biggest liability right away. Because you can't control the knife.
And that's before we get a board of directors? Or we need to
That's a part of getting your board of directors.
So health insurance, and then what's the second one?
Your biggest asset in your life is your ability to earn an income. You need to protect that.
Meaning?
Traditionally, that's disability insurance, disability income protection.
Which
Even
most employers won't. My employer now covers
You don't
that,
want your
but-
employer to do it. You don't want your employer to pay the premium on disability insurance. When your employer pays the disability insurance premium, if you are disabled, that becomes taxable income. If you pay the premium, it's tax-free income. But I would say the biggest priorities are get an emergency fund, get to working on your debt to pay out and be debt-free, and then begin the protection part of your life.
Okay, so you're saying before we pay off our debt, we should have that, some dollars saved. Because some people say pay off your debt first.
No. You can't dedicate all of your money to debt repayment because you cut your hand and now you're in debt again.
Right.
My mom and dad were divorced when I was at Grand Valley. My mom found out my dad had $54,000 of credit card debt. She had no idea it existed. If I knew then what I know now, she wouldn't have had a dime of it. But she took half of it. It's been over 15 years. She's gone from $27,000 of debt to over $100,000 of assets. And she was a factory worker. She worked at McDonald's. So what would I encourage you to do if you're not earning enough to pay off your debt? Get a second job. You're young. Do it. Bite the bullet. Get out of debt. But have an emergency fund first. A minimum of your health premiums. If you don't have health premiums, or your health deductible, if you don't have a health deductible, you better get it to 3 months of your expenses quick.
I'm just curious, like if a client came in to meet with you, didn't have a board of directors, do you have like a list of people that you might recommend, or?
I have 2 different lists. Boy, those professionals can make one of the 2 lists. I have a list of professionals that I would certainly trust my family with, and I have a list of professionals that if I hear you say a name, I will say, you should probably talk to one of these folks. Does that make sense?
Yeah.
Okay. Yes. You should be building your board of directors. And now I think we're all set. Is that it?
Yep, you are, I mean, nobody else is up, but it's at 7:47.
All right. So we can keep talking when Mindy comes around and says, I'm cutting you off. We can get out and mingle. Any other questions? Was there a follow-up? Okay. Again, if you've got any questions, In the folders outside, we didn't do a whole ton of them, but in the folders outside we have a financial calendar. This is a great first step to get your bills in order. The financial calendar, understand when money's coming in and when money's going out. There's a monthly expense worksheet. I just talked to somebody from the previous session that said I have to put together a proposal for what I want to earn. Do the monthly expense worksheet, and that'll tell you how much you need to earn. Then you can come from a position of planning and organization, and that employer during the interview should recognize that and appreciate the fact that you're organized that way. And then there's a debt-free review worksheet. If you do have debt and you're wondering how to get out of debt, I will give you some advice. If you do that worksheet and you sit down and talk to me, I'll tell you how to get out of debt. I would do that 3 different ways. The first is you can pay it off this way. You can pay minimum payments, and this is how long it'll take you to get out of debt. You can begin a snowball or commit a little bit more, and this is when you get out of debt by paying the highest interest first. This is how you get out of debt, by paying the lowest balance first. And we'll talk about those things, and that's a free service.
Do you recommend consolidating that?
That depends on what your credit report says. Part of your credit report, your credit number, when you go to the first-time homebuyer session, they'll tell you your credit number is all important. Part of that number is longevity of having debt. So if you've had a credit card for 5 years and you're going to consolidate somewhere else and close this one, you don't have a history anymore. So that dings your credit score. But that's a balance point. Anything else?
Thank you.
Thank you.